Hello and welcome. The tax planning season is back. All our investors are considering, where to put money when they do their tax plans. And we all know that Section 80C is one of the sections which I think probably every single investor uses to do their tax plans. Now, if you go through this section, what you find is that there are several kinds of instruments that you can invest into. So you can buy into investment-oriented products. So ELSS, for example, is a good example in that category. PPF, for example, is another product that some people use. There are also pension products which are a part of this section. You can also invest into insurance products as well. So at UTI, we thought, why not we offer investors a choice across all these segments? So I'm very delighted to share with you the UTI Smart Plan. Simply put, it is offering investors the choice of all the categories which are present in Section 80C. So if the investor is looking to invest into insurance, you can look at the UTI ULIP. ULIP is one of the oldest unit-linked insurance plans in the country. So obviously in insurance, one of the things we talk about is that you buy term and invest the rest. And this exactly is done in this product. So what you're buying here is a group term plan as far as insurance is concerned. So the cost for insurance is very, very low for the investor. And at the same time, the rest of the money is invested into a basket of equity and fixed income instruments. So you also get the best benefits as far as investments are concerned. So obviously, we do believe that UTI ULIP should be a part of every single investor's, portfolio, because it offers you the cheapest insurance and also offers you great benefits as far as investments are concerned. The second product in the UTI Smart Plan is the UTI Retirement Benefit Fund. And this product, by the way, has been in existence for more than 22 years. And if you are really looking at planning for your retirement and you want the benefit of active management in equities, and you also want to have the downside protection by investing into fixed income, this product exactly does for you. So the benefit you get is you get the upside of equities, and at the same time the downside risk is limited because of the investments on the fixed income side. Again, this product has been very popular with several of our investors, so I'm sure you will find it very attractive when it comes to your own investment choice or your customer's investment choice. The third product in this category is a very unique offering from UTI, which is called the UTI Long-Term Advantage Fund Series 5. Now typically every year, we have tried to really get a product in the market where we try to capture, probably what is the sweet spot in the equity markets. So of course we offer you diversified products, but what we do in this fund is try to create a concentrated portfolios of those stocks where we are extremely bullish on over the next 3 to 5 years. In fact, the budget which has come in recently only adds a little special flavor to this particular kind of fund. So I'm sure that 2.8 million investors, who are benefiting by investing with UTI in its tax saving kind of products, you will take these products to all your customers and ensure that basis their needs, they end up buying one of our products of the UTI Smart Plan. So if so many investors can benefit, why not yours? So wish you all the very best, and I'm sure my colleagues will take you through a little bit of more insight on how each of these products are managed.
Today I shall talk to you about the features of UTI ULIP and also the investment process as well as the portfolio construction behind this fund. To start with, let me share that this is the oldest ULIP existent in this country, as it was incorporated in the year 1971, and therefore it's completed 45 years of its existence very successfully. Being one of the oldest schemes, it carries various benefits which are a very low expense ratio, partly also because of a very low mortality premium that the scheme pays since it's a term insurance policy, and also having a very, very long and successful track record. Let me very proudly state that over the last 45 years, or should I say since inception, the scheme has given CAGR returns or annualized returns of close to 11% from inception to date, which is 31st December 2016. In fact, if I break this down into any 3, 5 or 10-year period, the scheme has very, very convincingly given above 10% annualized returns during any of these longer term periods. Well, the breakup of the scheme into equity and debt is broadly 40-60. So at any point in time, the scheme can go up to 40% in equity and the remaining into fixed income. Once the investor has decided whether he wants to go for a 10-year plan or a 15-year plan, he needs to then decide on the insurance amount that he is targeting. The maximum insurance cover that the investor can opt for is 15 lakh rupees, and the minimum that he has to run for is 15,000. Once the insurance amount is decided, the investor has a choice towards paying premium quarterly, monthly, semi-annually or even annually. One of the other benefits of this scheme is that this scheme is eligible as an investment under Section 80C. Therefore, a maximum benefit of 1,50,000 can be utilized by investment into this scheme. But if the investor so desires to have a higher investment into the scheme, he can obviously make an investment beyond 1,50,000, although the tax benefits would be limited to a sum of 1,50,000. Talking about some of the other unique features of the scheme, I think one of the most unique features that this scheme has, which perhaps has no parallel in the industry today, is that this scheme works on a self-declaration of your medical health. Therefore, it does not require any medical examination, that is a prior medical examination, which is a prerequisite by many other insurance policies. For investors to get into this scheme, they should fall in the age bracket of 12 years to 55 years. So theoretically, if you are, let's say, 52 years of age, you would still not require any prior medical examination to get on board into the scheme. Basis a self-declaration that you make, the investor can start paying premiums and target an insurance cover of 15 lakhs at the maximum if he so desires. Let me now talk about the investment strategy and the investment philosophy behind managing UTI ULIP. Let me restrict this discussion more towards the equity part of ULIP. The philosophy is predicated on the three pillars of quality, growth and valuation. To start with, what is quality? Quality in the simplest terms is nothing but the return on capital employed that any business generates. Now this is a very, very important attribute, because the higher the return on capital of any business, the higher is its potential to generate wealth. Focus on quality essentially means focusing on companies which have ability to generate high profitability measured by their return on capital, and therefore the ability of these businesses to generate huge cash into the future. And it is this ability to generate cash that makes them wealth creators over any long period of time. Now let's come to the second attribute, which is growth. It is not sufficient for a company to just be profitable. To be a long-term winner, to be a long-term wealth generator, the company needs to also have growth into the future. So we typically talk about business opportunities which have low penetration, and therefore the ability of these businesses to continue growing into the future. Quality, when wedded with growth, becomes a very, very potent combination. And I think the endeavor of our investment philosophy in ULIP is to identify these businesses which have the strong quality attribute. At the same time, they have a secular growth momentum waiting for them for the next 5, 10, 15 years. So the focus shall remain on these secular growth opportunities with high profitability, but always keeping the valuations in mind. And that's why I said that the three pillars are quality, growth and valuation. We would always be conscious about the fact that what is the valuation at which we are buying such businesses. Just to push the envelope further in terms of the investment process and our stock selection, and finally the portfolio construction, let me say that there are a few sectors which naturally qualify into this quality and growth parameter. These are private sector banks in particular, and not so much PSU banks, again because of the quality attribute. Certain select NBFCs, very, very selective over there. And then sectors like consumer sector. So consumer comes across as one of those industries where if you carefully pick out those businesses and those companies which are following these quality attributes, you should be sitting on wealth generators if you stay patient through the course. One of the other sectors which comes very close to the consumer sector is the healthcare sector. Here, if you have to visualize the growth potential, you need to remind yourself of the very poor penetration of healthcare services in the country. If you look at data in terms of per capita spend on medication and healthcare, then India is at a fraction of world averages as well as emerging market averages. However, the good news is that as per capita income improves, as GDP growth sustains and affluence starts to percolate through the society, we will also see higher per capita spends on healthcare. Therefore, the entire pharmaceutical sector has a very, very long growth runway in front of it, which to our mind makes it a strong potential for long-term wealth generation. One of the last sectors which I want to mention here is the automobile sector, which is one of my favorites when I talk in terms of numbers of penetration that is there, especially in the passenger car segment. So if you look at the passenger car penetration in India, we are at about 2% compared to US and Germany, which are at the other end of the spectrum, which are upwards of 70%. Even some of our neighbors in the emerging markets like China, Russia, Brazil are somewhere in the range of 10 to 20%. So you can imagine the huge growth potential that the entire auto sector has in terms of continuing to grow into the future. So to sum it up, I think we will continue to focus on our core pillars. Some of the sectors which are naturally amenable to such quality and growth attributes are the banking and financial services sector. Within that, the private sector banks, the consumer sector, and here you would have companies across the spectrum. You would have the pharmaceutical sector, and finally, like I said, consumer discretionary like auto sector. UTI ULIP, like I said, is one of the oldest, or rather the oldest insurance ULIP available in the country, which has the faith of 2.77 lakh investors. So with all these advantages, I think UTI ULIP is one of those unique schemes which offers our investors long-term wealth creation because of a very, very strong track record. And last but not the least, it offers tax savings to investors by way of taking benefits under Section 80C of up to 1.5 lakhs. So to our mind, UTI ULIP is one of those unique schemes which offers a win-win situation for both our IFAs as well as our investors.
The UTI Long Term Advantage Series 5, while an ELSS fund, is unique in that it takes advantage of a sweet spot in the economic cycle, which according to our research comes once in a decade. The performance expectations from this fund over the next few years are thus much superior to open-ended equity-linked savings schemes. The real story is in wealth acceleration. The 3-year lock-in allows specialized investment professionals such as us to calibrate portfolio risk in a bid for high returns. For someone who is planning to buy an apartment 5 years down the line, that could make up the difference between buying a 3-bedroom flat and a 2-bedroom flat, or while buying a car 3 years down the line, between buying a hatchback and a proper sedan. The theme of the fund is the business cycle, and presently we are at the cusp of the early part of the cycle, where cyclical companies typically see a sharp upswing in their earnings due to rising operating leverage, as contribution from higher volumes more than cover fixed costs. This was first seen in 1993-95 and then again around 2003-2006. Economic conditions in terms of inflation, interest rates and credit cycle are similarly placed today as in those two periods. And we think this is a great sweet spot for this fund to invest into companies which will see a J-curve jump in earnings over the next few years. The fund is essentially a once-in-a-decade opportunity for wealth creation, and it also has tax benefit boosters.
Today I am here to talk about a very important issue which probably in our younger days we completely disregarded. We start thinking about it in our middle age, and by the time we approach our old age or approach our retirement, we start worrying about it. What to do after retirement? How do we manage after retirement? We need a huge amount of money to build up for retirement because our expenses broadly remains the same, whereas our income drastically goes down post our retirement age. In this regard, there is an imperative need that we build a sizable corpus of retirement money whenever we retire, whether it is 58, whether it is 55, whether it is 60. Now, I just wanted to address a couple of trends here that we are seeing in terms of retirement. One is that the share of older people is already increased to close to 10% from about 5% 30 or 40 years back. The second one is that the average life expectancy has also increased to about 68, 69 versus 52 about 30 to 40 years back, which also makes it very imperative that we need to plan for at least 15 to 20 years of post-retirement living. Given the inflation that we would be experiencing in the major expenditure of any retired person, which is a medical, housing or other issues, we need a sizable corpus whenever we retire. In this regard, we have a very good product which UTI has specifically tailor-made for all of you, which is a UTI Retirement Benefit Fund. It's called the RBP. It's the oldest retirement fund in the mutual fund industry and leads the space in this particular category with more than 50% market share. Now, coming specifically to the fund, this fund has two ancillary benefits, a couple of ancillary benefits, such as it has a tax benefit which you can claim under Section 80C, and secondly, it also has some kind of an early liquidity possible, which is not there in other retirement options, fund options. I would like to highlight a few characteristics of the UTI Retirement Benefit Fund. One is a tax advantage. Now here, as I mentioned, this fund qualifies as an investment under Section 80C up to a maximum limit of 1,50,000. Now this fund is a asset allocation fund with 60% allocation towards debt and 40% allocation towards equity. Now we have kept this asset allocation thinking in view that this fund needs to be moderately conservative. So we have kept equity at 40, it's capped at 40. And debt is at 60, where again the focus is on conservatism. And this fund looks at a very longer term horizon in terms of investing, probably 5 to 10 years. So on the debt side, clearly we look at accrual papers, or at times if our in-house fixed income view is positive towards G6, we also look at G6, but by and large the focus is on accrual papers so that steady income accrues to the fund over a period of time. Coming specifically on the equity part, the equity specifically looks at a multi-cap kind of an approach. So there is a very good allocation towards mid and small cap stocks, which is almost 40% of the overall corpus, and the large caps is 60. Again, this is done because since we have a longer time horizon of 5 to 10 years for investment, we are clearly in the market to identify very good mid and small cap opportunities so that the fund can deliver very good returns over a period of